Welcome. Picture this: a single thriving restaurant where everything runs smoothly. Then success strikes, and you open another location and another and another. Suddenly, what worked perfectly starts breaking down. Payroll cycles clash, vendor lists multiply, revenue streams become a tangled mess. We're not just talking about more numbers, we're talking about separate teams, vendors, and operations that can quickly turn into chaos. This is where most growing hospitality brands hit a wall. But what if I told you there's a way to turn this complexity into your competitive advantage? Welcome to the world of multi unit hospitality accounting, the critical backbone that transforms expansion from a nightmare into a profit engine. Think of it as the operating system beneath your brand, the framework that creates visibility, consistency, and strategic control. Today, we're diving deep into how successful hospitality brands scale with confidence, not chaos. And here's the essential question we're exploring. Here's the brutal truth, and the question that decides whether growth feels like flight or free fall. Why do multi unit restaurants struggle to maintain profitability as they scale? It matters because without the right systems, expansion doesn't always mean more profit. Research shows growth can actually erode your margins. Think about it. You go from managing one set of books to juggling 10 different payroll cycles, 5 vendor systems, and revenue numbers that never quite match up. Fragmented data creates operational blind spots where margin leaks go undetected for months. Blind spots create slow or bad decisions, and bad decisions quietly destroy profitability. The stakes are speed, accuracy, and accountability across every unit every day. Store managers need daily, actionable numbers. Executives need a single enterprise picture. Without both, expansion becomes guesswork. In today's competitive landscape, slow financial reporting and these operational blind spots aren't just inconvenient, they're existential threats. But before we can solve this, we need to understand exactly why current approaches are failing. So, where exactly do traditional approaches fail? The gap is glaring once you see it. What works for a single location, or even two, often collapses by the time you hit store number 10. Single location bookkeeping works like a bicycle, simple, manual, perfectly fine for one location. But try riding that same bike to manage 10 locations across 3 cities, and everything breaks down. The month end close that used to rely on a heroic spreadsheet now literally snaps under volume. Your team is drowning in spreadsheets that don't talk to each other. POS data in one system, payroll in another, vendor invoices in a third. Inconsistent charts of accounts make cross-location comparisons unreliable. You're comparing apples to oranges when analyzing performance. Manual entries multiply, errors creep in, and by the time reports are published, the moment to act has passed. The result? Fragmented data creates operational blind spots where margin leaks go undetected for months. You're stuck in reactive mode, always looking backward at what happened last month instead of planning ahead. Store teams feel micromanaged when finance chases fixes. Corporate feels blind when numbers don't reconcile. This gap between simple bookkeeping and strategic financial management is exactly where growing brands lose their competitive edge. The solution isn't to work harder, it's to work structurally differently. But here's where it gets exciting. We've identified a proven framework to close this gap completely. The breakthrough approach is a complete framework, not a one-off tool. It starts with what we call building your financial backbone. First, we create a centralized chart of accounts that every single location uses identically. The same categories for sales, labor, COGS, and operating expenses across the board. No more comparing apples to oranges when analyzing performance. Next, we design a repeatable month-end rhythm with clear owners and timelines. Automated workflows that ensure your month-end closes happen like clockwork at every location, with clear milestones so the process doesn't collapse under pressure. But the real game changer is the technology stack, cloud accounting software that centralizes all reporting, POS integrations that eliminate manual revenue entry and sync sales automatically, inventory systems that give you real-time food cost visibility and connect directly to COGS, payroll platforms that standardize labor reporting and push costs without manual touch, and AP automation to tame the invoice flood. We layer in smart approval workflows that prevent spend creep without slowing operations. robust variance tracking that catches fraud and margin leaks early, and automated bank reconciliations that reduce risk and tighten integrity. The genius of this approach is that it creates a single source of truth while still serving different needs. Store managers get daily, controllable operational metrics. Executives get enterprise-wide performance indicators, cash flow, and growth analytics. With the structure in place, the question becomes, what changes when this framework goes live? When we implemented this centralized framework, the findings exceeded our expectations. The breakthrough is turning fragmented data into a real-time decision-making powerhouse. Daily sales land in accounting automatically. Payroll pushes labor costs without manual touch. Vendor invoices flow through approvals into payables. Inventory connects directly to COGS. By unifying POS, payroll, and purchasing data into a single financial view, leadership gets one source of truth. Now you could monitor labor percentages across all locations simultaneously. Store managers get controllable dailies, executives see enterprise profitability, cash flow, and growth metrics. Real-time dashboards turn data into immediate action, catching a rising trend at one restaurant before it infected the others. When margins started declining at a single unit or labor costs crept up, leadership intervened within days, not months. The variance tracking caught a potential fraud situation in week 1 that would have gone undetected for quarters under the old system. Weekly variance reviews and automated bank reconciliations reduced risk and tightened integrity across the board. Most importantly, we found that location-level accountability frameworks actually empowered managers rather than constrained them. Each manager received simplified financial summaries connecting their daily decisions directly to profitability. They could see their P&L, hit labor targets, and manage prime costs, turning data into daily action. The system protected margins without creating bureaucracy. But the real proof came when we looked at the broader implications for scaling. In practice, the implications of these findings are transformative for the entire hospitality industry. This becomes a complete playbook for sustainable expansion. Every new unit onboards the same way. Chart of accounts set from day one, payroll configured, vendor templates ready, reporting turned on, ensuring consistency from the first transaction. Brands using this approach scale with complete confidence, knowing their margins are protected by robust controls and real-time visibility. We saw restaurants move from 5 to 50 units while maintaining consistent profitability because they had a finance roadmap guiding every expansion decision. Technology upgrades at set milestones, CFO services introduced for forecasting and scenario modeling, controls expanded as complexity grew, and functions outsourced where it reduced overhead and accelerated speed. Outsourced restaurant accounting emerged as a game changer, giving brands access to CFO-level strategy without the overhead of building an entire finance department. Perhaps most importantly, we discovered that training managers to think like operators and owners created a culture of financial literacy that improved performance across every single metric. Site selection became data-driven through unit economics analysis, separating strong sites from weak and eliminating guesswork. Cash flow modeling allowed operators to know exactly when they could afford the next location and time openings precisely. The bottom line? Multi-unit hospitality accounting doesn't just support growth, it actively drives it. Finance moves from after-the-fact bookkeeping to proactive navigation. But this leads us to an even bigger realization about the paradigm shift happening right now. This research reveals nothing less than a complete paradigm shift in how hospitality brands must approach finance. We're moving beyond the era where bookkeeping simply records past transactions. The future belongs to restaurant CFO services that provide forward-looking forecasts, scenario modeling, and strategic cash flow planning. With visibility, consistency, and controls in place, leadership gains strategic clarity: where to deploy capital, when to open the next unit, how to protect margins as complexity rises. The command center replaces the shoebox. Approval workflows curb spend creep without slowing operations. Variance tracking and reconciliations safeguard integrity. Forecasts and unit economics steer timing and site selection with precision. This evolution transforms multi-unit hospitality accounting from a cost center into the central nervous system of your entire operation. As unit count grows, the system evolves intentionally. Technology upgrades, stronger controls, and ongoing training built into the roadmap. The brands that win will be those that treat financial infrastructure as their primary competitive advantage, not an afterthought. Looking ahead, we see a future where automation handles all routine tasks, allowing finance teams to focus entirely on strategic growth decisions. Finance becomes not just support, but propulsion. The roadmap is clear. Evolve from reactive bookkeeping to proactive strategy, from fragmented data to unified intelligence, from back office support to boardroom leadership. This is the resolution that separates tomorrow's market leaders from today's struggling operators. And now, let's bring this all together with your blueprint for action. So here's your blueprint for sustainable expansion. Let's recap the play. Multi-unit hospitality accounting isn't just a nice to have, it's the essential backbone that transforms finance from a back office headache into your primary growth engine. Remember the key takeaways. Standardize your chart of accounts so every unit speaks the same financial language. Create a repeatable close process with clear owners and timelines. Integrate POS, payroll, inventory, and AP into a single source of truth that eliminates manual entry. Design tiered reporting, where store managers get controllable dailies and executives see enterprise performance. Enforce smart controls through approval workflows and variance tracking that protect margins without slowing operations. And elevate to forecasting, scenario planning, cash flow modeling, and unit economics that guide every expansion decision. Train your managers to think like operators and owners by understanding their P&Ls. Draft a finance roadmap from 5 to 50 units with clear milestones. If your internal team is stretched, consider outsourced accounting and CFO services to add expertise while reducing overhead and accelerating growth. The brands that scale successfully all have one thing in common. They built their financial infrastructure before expansion broke their systems. So here's your call to action. Pick 3 steps from this checklist and start this quarter. Assess your current accounting framework today. Identify the gaps. Choose technology that grows with your footprint. The sooner your backbone is in place, the faster and safer you can scale. And most importantly, recognize that in today's competitive landscape, world-class financial operations aren't optional. They're your competitive advantage. Scale smart, scale strong, and scale with confidence. The future belongs to brands that build their backbone first. Connect with Forks for the experienced accounting professionals your restaurant needs. Details and description below.